Welcome back to Money Shorts. Remember to subscribe so that you don't miss an episode. We are talking about the different ways to save in an attempt to beat inflation and increase the buying power of your money over time. Today we're going to talk about shares or equity, and we're going to discuss the advantages and disadvantages, the good and the bad about saving in this way. The good thing about investing in shares is that it has the best potential to beat inflation over time, as it will grow at the highest rate, more than inflation, than any of the other assets that you can invest in. The reason is that the prices of the shares go up and down on a daily basis, and over time, this stretches out into a nice straight line, giving you a higher overall outcome than some of the other things like cash that will have a more straight line over the term, but a lower outcome in the end. The other nice thing about investing in shares is that you are not putting all your eggs in one basket. That means that you are diversifying. It's the big word we use in investing. By putting your eggs in one basket, it means you're buying one specific thing, and when that basket drops, all the eggs has the potential to break. But if you invest in shares, you can pick different kinds of shares from different types of sectors on the market, which means you have shares that is diversified, or eggs in different baskets. Another nice thing about investing in shares is that you don't have that easy access to it. You will need a platform to invest in shares, and therefore it's not as easy as cracking open that piggy bank or going to the bank and drawing some money from an ATM. Means that it's more difficult for you to draw, so your money will last longer because you will think twice before you access it. The bad thing about investing in shares is that it can be quite scary. Because it goes up and down every day, you shouldn't be looking at it every day. But if you look at it on a down day, you might get a little bit of a fright if you see your money is less than what you put in. That is why you need time. Because over a long period of time, of at least 7 years or longer, all the ups will be added together, and you will have a very nice surprise in the end of how much your money that you initially put in has grown. Time is the main factor when it comes to investing in shares. And then, of course, what I've already mentioned, making sure that it's in different sectors, different areas of the market, so that if one basket drops, only the eggs in that basket will break. The eggs in the other baskets will be safe. The other enemy of investing, other than fear, is greed. So we talk about fear versus greed when it comes to investing. The fear is that you see your money go down and then you have the temptation to draw it. That's not a good idea, because you might be selling those shares at a lower price than you bought it for, which means you lose. You should just stick it out, leave it in there for a little bit longer until it recovers and until it is more than what you've put in. Then greed is when you see, ooh, look at it grow, it's going up the whole time, and you don't sell it at the right time, but you just stick it out and hoping you'll get more and be greedy. Then in the end you miss that day where it did drop, and if you sold it one day earlier, you would have gotten a better price. This is why it's important to use somebody to give you advice and help you determine the value of the shares so that you sell at the right time. The main idea is to buy low and sell high when it comes to the prices of shares. Thank you for watching Money Shorts. I hope to see you next time. Remember to subscribe.